My name is Kurt, and I achieved financial independence at 31 by investing in real estate. This video on net operating income is the second in a series that I'm doing on foundational real estate investment concepts that I believe every new or aspiring real estate investor should know in order to get on the fast track to financial freedom. There are a variety of different metrics for defining the income of a property, and all have their place. Investors must know these industry standard metrics and understand their differences and when each is used in order to successfully compare, value, and underwrite deals. Net operating income, commonly referred to as NOI, represents the income of a property minus its expenses, excluding debt service. Debt service just means making payments on your loan. Typical things to include as income are rent payments, income from laundry facilities, income from amenities like storage or parking, and any other sources of income that the subject property reliably receives each month. This income is all to be factored pre-tax. Things to include as expenses are maintenance, property taxes, insurance premiums, utilities that are paid by the owner, property management fees, or any other predictable or recurring expenses of this nature. Remember, net operating income, or NOI, explicitly excludes debt service. CapEx, which is an abbreviation for capital expenditure, is excluded as well. CapEx comprises expenses that are more like one-off improvements to a building. This could include the installation of a new boiler system or renovations to units. Net operating income allows you to compare the income of different properties independent of financing terms. NOI is also commonly cited in commercial real estate as it is one of the primary inputs for determining the value of a property. Unlike 1 to 4 unit residential properties, which are valued based on comparables, commercial real estate is valued more on the basis of income, like a business is. When valuing a commercial property, the net operating income is divided by the cap rate to determine the value. Higher income equates to higher values. Lower cap rates also equate to higher values. It's not always this straightforward in practice, but does paint the picture for how increasing the income of a property also increases the value. Cap rate isn't the focus of this video, but functionally, it's a measure of the desirability of a particular asset, and as a general rule of thumb, the more desirable an asset is perceived by the market, the lower the cap rate will be. High-end assets in desirable locations tend to have low cap rates because a lot of people want those kinds of assets, and as such, increased competition for them results in a willingness to pay more upfront for these assets relative to the income that they produce. Put another way, buyers of these desirable assets accept a lower return on investment because they believe that the higher-end asset offers other benefits, such as, but not necessarily, higher quality tenants, lower risk, more potential for appreciation, and so on. So yeah, if you're investing in residential properties, you care about NOI from the standpoint that it's a precursor to determining your cash flow. And as an extension of that, your cash-on-cash return, which I did a whole video on. If you're investing in commercial properties, you care about NOI not just because it's the precursor to cash flow, but because the NOI divided by the cap rate gives you an idea of what the property is worth. Knowing this relationship allows you to predict how much you can increase the value of a property by increasing its income. For example, a property with under market rents has a net operating income of $20,000 per year and a cap rate of 10%. Given that, it's worth about $200,000. If you buy the subject property for $200,000 and raise the rents to market rate, yielding a new NOI of $24,000 per year, the property is now worth $240,000 because you increased the NOI. Congrats, big shot. You just raised your net worth by $40,000 by bumping your rents up to market value. Got him. Here's a table to better illustrate the point. You can see what different net operating incomes do to the value of a hypothetical commercial property at different cap rates. As always, thank you for watching. If you got value out of this explanation, please give this video a like for the YouTube algorithm, subscribe, and turn on notifications so that you don't miss future content. And check out the other videos in my series on foundational real estate knowledge so that you can get yourself on the fast track to financial freedom. Have a great day.